While the rest of the world is looking at their stock portfolios, something historic just happened in the silver market. And if you aren't watching the spread between New York and Shanghai, you're flying blind. On December 29th and 30th, 2025, the global silver market didn't just crack, it bifurcated. You've heard the silver squeeze narrative for years. You've heard that the COMEX is empty. But here's the cold, hard truth that the mainstream media is missing. The market is broken, but not in the way you think. Right now, there's a $12.93 per ounce price gap between the West and the East. That yes, an 18.3% premium for physical silver in Shanghai compared to the paper price in New York. In any normal market, arbitrageurs would buy in New York, ship to Shanghai, and pocket the easiest 18% profit in history. But they aren't. They can't. Why? Because the silver curtain is falling. Let's look at the numbers. As of the market close on December 29th, 2025, the Shanghai Gold Exchange SGE saw silver AGT plus D closing at CNY 18797 per kilogram. When you run the math, dividing by an exchange rate of 7 and the 3207 troy ounces in a kilo, you get a converted price, glass 83.51 per ounce. At the exact same time, the COMEX December 25th contract was sitting at Sigu on Sindai from 518. Think about that. If you're standing in Shanghai, silver costs $83. If you are standing in New York, it costs $70. This isn't a gap. This is a decoupling. It tells us that the Western paper price has lost all connection to physical reality. While Western paper markets liquidated on December 29th, pushing prices down to that $70 level, Eastern physical buyers refuse to follow. They maintain a significantly higher floor because they know something we don't. Now, here's where it gets dangerous for the average investor. If you've been following the silver drain thesis, you've probably heard that the COMEX vaults are running dry. You're waiting for the registered inventory to hit zero so the price can moon. I have a warning for you. The drain is not happening where you think it is. The latest CME Group Silver Stocks report shows that registered inventory, the silver specifically available for delivery, actually stands at 127.62 million ounces. To put that in perspective, 12 months ago, we were looking at levels in the 70 million ounce range. In August 2023, it got as low as 27.6 million. So, is the COMEX empty? No, it's actually more liquid now than it was a year ago. This is the trap. The bullion banks haven't run out of silver. They've successfully restocked the show window. They likely moved metal from eligible, the silver owned by private parties, just sitting in the vault into the registered category to prevent a technical default and keep the paper game running. If you trade on the assumption that the COMEX is empty today, the banks will eat your lunch. But don't let those inventory numbers fool you into thinking everything is fine. The stress isn't in the volume, it's in the structure of the market. While the COMEX is busy polishing its registered numbers, China just made a move that effectively weaponizes the global silver supply. Starting January 1st, 2026, just hours from now, China is implementing massive new restrictions on silver exports. To get silver out of China, you will now need a specific government license. This isn't just bureaucracy. China is essentially trapping its silver domestically to feed its own solar and industrial complex. China knows that silver is the most electrically conductive metal on Earth. They know it's the Achilles heel of the green energy transition. By restricting exports, they are forcing a permanent decoupling. They are telling the West, you can keep your $70 paper price. If you want the physical metal, you pay the Shanghai price, or you don't get it at all. If you want proof that the physical market is screaming for help, look at the futures curve. We are seeing a classic signal of immediate physical shortage, backwardation. Usually in a healthy market, silver for delivery next month is more expensive than silver today because of storage and insurance costs. But right now, the market is inverted. The December 2025 contract is at 70.58T, while the January 2026 contract is lower at home 70. The market is literally paying a premium to get the metal now instead of waiting 30 days. This is abnormal for a non-P perishable commodity. It confirms that despite the registered inventory rise, industrial buyers are panicking behind the scenes. We are witnessing the birth of two silver markets. A Western corporate paper market where prices are suppressed by margin hikes and technical liquidations, and an Eastern physical market where the price is 13 higher and the metal is disappearing behind a licensing curtain. The broken market thesis has been validated. The arbitrage gap is real. But if the COMEX isn't empty and the price is still $70 in New York, what is the trigger that forces the West to recognize the $83 reality? The answer lies in a specific shift in the eligible stocks, the shadow inventory that the banks don't want you to calculate. And that is where the real smoking gun is hidden. That's the question everyone is asking. If the vault isn't empty, why is the price in Shanghai screaming? To find the answer, we have to stop looking at the registered stocks, the silver the banks want you to see, and start looking at the eligible category. This is the shadow inventory, the private stashes, and it's where the real bloodletting is happening. In the silver world, registered is the silver with a warrant, ready to be delivered on a contract today. Eligible is everything else sitting in the vault that meets the exchange's requirements but isn't currently for sale. Most people think eligible is a backup tank for registered. They think if the banks run low on delivery bars, they just tap the eligible pool. But here's the insider reality. Eligible silver is not the bank's silver. It belongs to hedge funds, private family offices, and wealthy individuals who are just using the COMEX vault as a high-security parking garage. When you see it, registered stocks rise from 27 million to 127 million ounces over the last 2 years. You aren't seeing new silver being mined. You're seeing a desperate shell game. The bullion banks are likely bribing or incentivizing eligible holders to register their metal to keep the exchange from failing a delivery. They are moving the chairs on the Titanic to make the deck look full. But while they were busy restocking the show window, the total inventory, the sum of everything in the vaults, is telling a different story. The drain isn't a myth, it's just being masked by internal transfers. You might be wondering, if I can buy silver for $70 in New York and sell it for $83 in Shanghai, why aren't the big players doing it until the gap closes? In a functional market, that's exactly what happens. It's called arbitrage. But the market is no longer functional. To pull off that trade, you need two. 1, buy the physical bars in New York. 2, secure armored transport. 3, wait for the shipping window. 4, clear Chinese customs. 5, deliver to the SGE. But here's the kicker. The lead times for physical delivery on the COMEX have blown out. We are seeing reports of physical premiums in Shanghai reaching over 8.0 per ounce relative to international spot, even before the latest price divergence. That means the cost and risk of moving that metal are now so high that the 13 gap is barely enough to cover the friction. The silver arbitrage gap isn't just a number on a screen. It is a measurement of how difficult it has become to move physical metal from west to east. The plumbing is clogged. Why is Shanghai so desperate for silver that they'll pay an 18% premium? It's not just speculators, it's the industrial engine. China dominates the global solar panel industry, and solar cells require silver paste. As they push toward their 2026 renewable targets, their demand is inelastic. They don't care if the paper price in New York is $70. They need the atoms. By implementing export restrictions effective January 1st, 2026, Beijing is signaling that they are prioritizing their internal industrial complex over global liquidity. They are essentially creating a silver black hole. Metal goes in, but it doesn't come out. Here's the part that should keep you up at night. For every ounce of silver sitting in those COMEX vaults, there are hundreds of ounces of paper silver traded in the futures market. When the SGE price stays at $80 and the COMEX tries to hold $70, you create a pressure cooker. Eventually, the holders of those paper contracts in New York are going to realize they can't get the metal at the discountest price. They all see the silver curtain falling in the east, and they will all rush for the exit at the same time. The banks have successfully defended the registered numbers for now, but they did it by cannibalizing their future reserves. They could have used their ammunition to keep the price at $70 while the rest of the world is paying $80 to dollars. This isn't just a price discrepancy, it's a countdown. We've covered the trap. We've looked at the shadow inventory shell game, but we haven't talked about the Jan 1st trigger. In the next phase, we are going to look at exactly what happens when those Chinese export bans go live, and the Western industrial buyers realize they've been locked out of the world's largest physical market. The broken market is about to become a shattered market. Now, we get to the end game. If you followed me this far, you'll realize the registered inventory is a distraction, and the $13 gap is a warning. But the real detonation happens in exactly 24 hours. On January 1st, 2026, the silver curtain officially drops. China's new export restrictions aren't just a policy tweak. They are a strategic seizure of the world's most critical industrial metal. Think about the position of a Western industrial buyer, someone making solar panels in Europe or semiconductors in the US. For years, they've relied on the global flow of silver to keep their assembly lines moving. They've looked at the COMEX price of $70 and figured they could always source metal if things got tight. But as of tomorrow, the door to the world's largest physical warehouse is locked. If you want silver from China, you need a license that you probably won't get. This forces every major industrial player to look at the COMEX registered stocks, that 127 million ounces we talked about, and realize it's the only game left in town. Here's the problem. 127 million ounces sounds like a lot until you realize the global industrial deficit has been running at hundreds of millions of ounces per year. A drain that has not shown up in the COMEX data is about to hit like a freight train as Western buyers realize they can no longer outsource their physical needs to the East. In a normal market, the 13-year gap would be closed by people moving metal. But with China's export ban, the arbitrage becomes one way. You can move silver into China to capture that $8,305 to $1 price, but you can't bring it back. This creates a permanent drain on Western liquidity. Any mobile silver, the stuff not bolted down or held in private eligible accounts, will be sucked into the Shanghai vacuum to chase that 18% premium. The result? The CU comes registered inventory, which the banks worked so hard to rebuild to 127 million ounces, is going to face a level of delivery demand it hasn't seen in decades. We are moving from a broken market to a shattered market, where the price isn't set by a guy in a suit in New York, but by the physical reality of a solar plant in Jiangsu. The mainstream narrative will tell you that silver is crashing because the COMEX paper price is dropping towards $70. They'll point to the rising inventory and tell you there's no shortage. They're looking at the show window while the warehouse is being emptied through the back door. Here's how you play the next 60 days. 1. Ignore the registers. Registered numbers. Watch the total vault levels. If the banks keep moving metal from eligible to registered just to keep the lights on, they are running out of maneuvers. 2. Watch the basis. If the premium in Shanghai stays above 8 points worse, the silver curtain is holding, the east is setting the floor. 3. The backwardation signal. As long as the front-end futures curve stays inverted, John 26 lower than Dec 25, the physical shortage is immediate and real. The banks have defended the COMEX against a technical default for now. They've successfully restocked the display case, but they can't manufacture atoms. As China disconnects on January 1st, the Western paper market is going to find itself in a room with no exits and a lot of hungry buyers. The broken market thesis isn't a theory anymore. It's a documented fact. The gap is $12, 93 hours. The inventory is a shell game, and the clock just hit midnight. The question isn't whether the COMEX runs out of silver tomorrow. The question is, when the world realizes the price is actually $80, will you be holding the paper or the metal? Disclaimer, this is not financial advice. Gold, silver, and markets are volatile. The information provided is for educational and entertainment purposes only. I am not a financial advisor. Always conduct your own research or consult with a professional financial advisor before making any investment decisions.